Our next guest is one of the best forecasters around on oil prices. And the last time he was on with us, about 3 weeks ago, he said crude markets were overreacting to the unrest in Egypt. Well, a lot has changed since then, including violence in Libya. So we wanted to know if his views had changed as well. Jason Schenker is president of Prestige Economics. He's in Raleigh, North Carolina this morning. Jason, welcome back to the Inside Track. Violence in Libya, we've seen the footage of what's going on in Bahrain, but most importantly, Libya is an OPEC producer, so can you still look at things the same way you did 3 weeks ago?
Well, I think we can actually look at it relatively similar. We did say that when I was on a few weeks ago, if things spilled over to OPEC member states, then we'd have a little bit more to worry about. Is that something I'm going to be looking at when we revise the forecast this month? Yes. But I think there's still some downside risk when we look going forward, because there are two main questions that have been raised by the Egypt situation. And the first is, if we had looked at the Middle East and we said there were power changes, would we see the transition as relatively smoothly as we saw in Egypt? Would there be a changing of the guard in various countries that we look at as being authoritarian? Would there be such an easy regime change? And if that were to continue across countries, does that mean that this entire region may be full of paper tigers? That essentially, if the people want regime change, it happens, and there may be some violence, but it might not be at the scale that we thought. And that would be somewhat bearish for prices. At the same time, if we see something like this happen in OPEC member states, and there is regime change in Libya or elsewhere, and they decide to pull out of OPEC, what does that mean for oil prices? Is that bearish too? So we still see a couple of factors that could really keep prices from going to the moon. There's a reason right now why WTI is still at $93 and Brent's at 107, and we're not looking at much higher prices. And those two questions are what's keeping us where we are.
Okay, so do I take it then, Jason, that you believe once again the conditions do not exist for a real spike in oil prices to levels like we saw in 2008?
Well, I think conditions exist for a spike. However, I would argue that the price levels we saw in 2008 were engendered by a much larger number of factors. If we look at different supply disruption premia that were priced in for various events, including a number of events historically with Iran, the premium that gets priced in is probably not enough to push us way back up to that sort of $150 range. At this point, it would take something much bigger than what we're looking at. Right now, the markets are priced in the probabilities of things happening. But then again, you still look at something like WTI, where the supply, where the inventories are keeping that price depressed, and we're still at $93.50 right now.
Okay, but there's an important question to ask about that, because the spread between WTI and Brent has narrowed dramatically overnight. What does that signal? Does that signal that finally oil investors, or at least investors in U.S. crude futures, see serious supply concerns coming out of the Middle East?
Well, not really. And here's why. Because even though it's narrowed somewhat overnight, we're still looking at a $14 spread. That's huge. Historically, WTI should be trading a little bit above Brent, not at a $14 discount. This is massive. I cannot emphasize enough how big that disconnect is. But if there really was a concern that would exceed the supply and demand dynamics, a real genuine global disruption expectation that would feed through to U.S. inventories, then that price would likely be much higher throughout the entire WTI forward curve. And we just don't see that. We see that in Brent. That's a non-physical crude, that there's no physical delivery. For WTI, eventually, it's a physical delivered crude. So you're going to end up with that oil if you don't close out your contracts right. And in a market where you look at inventories of gasoline in the U.S., the highest levels in 2 decades,
Jason,
and we're going into the shoulder period, there's a lot of supply out there. And that's going to be keeping prices low.
Jason, I'm sorry we have to run. Jason Schenker of Prestige Economics, one of the best oil forecasters around. You heard him right there.